All right, last night, while you're getting to going to bed, and it's Sunday night, and the futures are open, and we're down, a one standard deviation. So there was a pretty good chance last night going to bed that we would have the beginnings of a runaway gap type of the beginnings of an intermediate pullback. We opened, wake up this morning and we are right on. Like this could be it, and we fell, continued to slide. We opened, ran away, and has all the makings of an intermediate decline. And then we rallied into the close. So now what do we think? Is this it? Is this the decline? Was that last buying a bear trap, or was it a sign that we're just going to continue to fill in that gap? So I'm going to break that down in today's video. I mean, this could be the selling we've been waiting for a long time. Was it too much all in one day, as it usually almost always is the case here lately, that we can't maintain it? So I'm going to break that down as well. Our trade idea is a stock in a sector that was one of the worst ones today. That very well could be one of the worst ones for a while. So we'll look at a candidate within that area for a bearish opportunity to talk about how to trade that. So let's go ahead and get started. Today is Monday, September the 20th, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's take a look at the S&P 500 with the market forecast indicator. This is the first day. We've gotten a dark pink shading and a red line pattern here in quite a while on the S&P 500. Even with the long lower shadow that we got, you'll see that that long lower shadow right there was actually not, I mean, that's as bad as things were today, that it could have been worse, obviously. But the fact that it wasn't that bad is actually a really good thing, and we'll talk about as we go through the video today. But again, dark pink shading and a red line, which means the intermediate line is down below 50. Now, it's not down below 40 yet, but obviously, barring a big change tomorrow, more than likely, in fact, I believe actually we'll probably trade within that range. Well, that low points is going to be a support level. It's not going to be like the support level, because there is no the support. But it is a support level. But I think we'll trade in that range tomorrow. So I think we will get eventually below 40, but probably not any closer than that. You notice we're already getting potentially a bullish near-term divergence. So the near-term line has dipped below 20, just barely. It was a higher low point on the near-term line. It's obviously a much lower low point on the index itself. So just like that, you already have a bullish divergence. The momentum line over. So we are 2.5% down below the moving average. If you see, that's typically a pretty decent sign that we are down. That we are down enough to be considered a pullback mode. You notice none of these got down 2.5%. March we got really darn close, about as close as you could get to getting down to 2.5%. Of course, when we actually did get a legit intermediate pullback here in September, we did finally get below. So 2.5% is the mark. It appears for the S&P 500. It's not the mark for everything, but for the S&P 500, it appears to be that level that we're like, okay, that's enough of a decline that can be considered, kind of a red zone, so to speak. In fact, we'll kind of make it a little bit of a red zone right here. That we've gotten down to that point. We can consider it a pullback, right? Dark pink shading and a red line, and we can consider a pullback. Now you notice, even at the lows of the day, we still were not close to breaking below that 23% retracement. Remember, retracements don't start until you break the 23% line. So, this might be, again, a very, very weak, like even this intermediate pullback barely dipped its toe below, and that was legit. We got down below, in fact, the intermediate line got below 20. So it was pretty legit of an intermediate pullback, but not strong enough to even, just barely strong enough to get below the 23% at the time. Now you can see the orange line, which is what it was, has moved all the way up to where we'd have to break below this 4,000 level to get a market sentiment decline, which is where the orange line dips all the way into bearish territory here on the long-term basis, and typically coincides with the a break of the 23% level on the longer term basis. In this case, since the COVID low point, because that's the bullish run we've been on with only one single intermediate decline in between. we are obviously on an intermediate decline now, and that's the case too on the Dow Jones Industrial Average. You can see we have we've been below 20 already, so it's nothing new. We've already had dark pink shading the red line, so it's nothing new there. We had dipped below the 23% level of this current intermediate run, because the Dow did have an intermediate pullback. So on the Dow's current run, we had already dipped below. In fact, we had dipped below the 30% level going into on Friday before the market closed on expiration Friday. We've actually now completed all the way through the 62. And remember, when you break the 78, the retracement's over with. In this case, not because we've bounced, but because now we're no longer just retracing. Now we're on a bearish move. And so you also see that black line there. That would be the intermediate line. That would be the same run that the S&P 500 is on, because remember, it did not get an intermediate pullback. So just to kind of keep it the same, it's off of that Halloween low point too. And so today's low point got closer to it than the S&P did. Of course, your NASDAQ's been the most bullish. Its intermediate line is actually still in the bullish territory. So it's like, and again, we are set up for a real significant bullish divergence pattern here. We are 2% below the moving average, but you can see for the Nasdaq, it's a little bit more. You can see 2%. This is where 2% is, where my cursor is. 2% is a relatively small number as a higher beta. So we're actually not in intermediate pullback mode yet for the Nasdaq, and the Russell also. It didn't have nearly as big of a decline. And you can see it's still not quite to its 23. It actually has tested its 23% retracement a few times. And you can see, again, it gets further below. And we've had intermediate pullbacks already, just barely. But we've had intermediate line dips below 40. And it appears that this is going to make another attempt to dip below 40. And no bullish divergence here, because the near-term line is barely turning over. Whereas on the others, the near-term line had already turned over. On the other indexes. If we take a look at the long-term view, what do we see when we look for an intermediate decline? We look for a bearish Hakinyashi candle, a falling PPO, and a red arrow. And voila, we have it. And on the S&P finally, of course, remember the Dow has already had it for a few weeks, right? We got it a couple weeks ago. And then, of course, when you look at the NASDAQ, we're just barely getting it here. Falling PPO, bearish Hakinyashi candle, red arrow. And then the Russell 2000, we've again already had the red arrow. We've had a bearish Hakinyashi candle again, and the PPO has already been falling. Right, it's dropped considerably down to below 4% here as we've been. Look at the 40-week exponential moving average is actually above the 23% retracement. If you look at the 3 green arrow charts for these major indexes, light pink shading, and it doesn't look like, see, you either get light pink shading and then we get back to clear really quickly and within a day or two maybe. It doesn't look like it's going to be a day or two this go around. We are deep enough. That's why we look at the 2.5% mark, because are we deep enough below the moving average that we're likely just to come right back up like this, or are we going to stay down there like it's done on the Dow? That's what, obviously that's the intermediate decline when you stay pink, and that's what it appears like we are headed towards. If you look at the 2-line versions of this chart, you can see the S&P broke below the 50-day moving average on Friday going into the close, but now we are well below the 50, so very unlikely. But remember, we get our biggest bullish moves to the upside when we are significantly below, especially the 8-day moving average. So I won't be surprised at all if we don't get a big bounce. Now, if we get a big bounce, we'll fill in some of that gap. So that's that will be interesting to see the timing and whether or not we stay in this range tomorrow. But the 8-day moving average is going to catch up. We're either going to get a big bullish candle to the upside, or we base and the 8-day catches down. But more than likely we'll bounce. Look at the extreme volume. We'll take a look at that in a second. But we're extreme volume, we're extreme on the trading ranges. That usually leads to bounces when it's that extreme. Let's take a look at some of these other oscillators. The RSI and the CCI breaking well below 40 for the first time since September. Definitely in bearish territory on the CCI too, below 200. These are bearish breakout patterns here. The DMI is also, look at that spike on the negative index, way up there above 35. That's very typical for bearish spikes, right? You can see some of these other intermediate declines and how they start with these bearish spikes. And this is about as bearish of a spike that we've had, right? We actually had one over here at the end of that March decline. And you can see now the positive indicator is down to 10. It hasn't been down to 10 since the COVID drop, right? And then before that, the fourth quarter of 2018. It's very rare for it to get that low, which again suggests that this is very extreme. Pretty much, I would venture to guess that we probably had a little bit of selling, time frames worth of selling, whether it's a week or two, all today. Like we've kind of maybe pulled a lot of it forward into one big extreme move. Let's look at the Ichimoku cloud, and you can see we're above 1 or below -1, above 50. So we have a weak bearish trend developing. You can see we're still in the cloud, so we haven't broken through the cloud, which would suggest that we're more bearish. We are below the cloud here, but it's a very flat cloud, so we're not. It's one thing. It's not considered a support or a resistance, as you can tell when it's flat and skinny like that. It's considered a support when you've got a cloud like this. And obviously you can see these two indicators at the bottom suggest that we are in noisy period, and the Qs just barely went to 0. So it's also spending a day below the blue line. It's also still above the cloud, and there's a significant cloud, so that makes it the top and the bottom support levels. So we could very well trade here to the 23% retracement level by next week and still be kind of holding the cloud for support. But you can see we're not like in danger of a strong bearish trend anytime soon, because we just barely halted a bullish trend on that indicator. And then I want to take a look at the Bollinger Bands for the S&P 500, obviously breaking below the lower band. In fact, we had broken below the lower band and the Keltner channel on SPY. So that's a significant breakdown. And you can see also the bands have broken out from inside the Keltner channel. So that's a pretty significant break according to that pattern, as well as again other patterns that we've seen. IWM, you can see, did not break below the lower band or the Keltner channel. We were below it at the at the lowest of the day, but we didn't finish down there, so not as bearish there. The diamonds did break down, and we did get the green dot with some increasing bearish momentum. And then the Qs also broke down below the lower band and the lower Keltner channel. The bands are still inside the Keltner channel according to this red dot, but you can see they're moving in a direction where that's probably not going to last very long. So that's a bearish breakout pattern. Lots of bearish breakout patterns here. You wonder though, this isn't the first time we've seen these kind of patterns on the S&P 500 even. You can see like over here, we broke below the lower band in the Keltner channel and rallied off of that. We broke below the lower band over here briefly and then rallied off of that. We broke below the 50-day moving average multiple times and rallied off of that. So it's going to be really important, especially here, to see how we handle that high point, right? That's got all the makings of a runaway gap. I've told you on this particular chart, there are 3 things we look for to show us that we are starting an intermediate bearish pullback, a run to the downside. One is a significant gap to the downside, and that was more than 2 standard deviations, so that met that criteria. It only needs to be 1 down there. The second thing is a jump in volatility, which we kind of got, a little bit of a jump in volatility. You'll see it wasn't that significant here in a minute. And then number 3 is a close of at least 2%, and we didn't get that. And so again, you put that together with this volatility move. We jumped up, right? We gapped up to 100%. We didn't get through 100%. We're actually down, and it's very rare. Even when we got this kind of really weak pullback back here in September and October, you notice the pullback started right there, and we got up to 30. But we only got up to about 90%. We ended with the worst of the volatility, right there, Halloween low point. So it's not common. That's more the anomaly than the norm. It's normal for us to get at least above 100, if not up to 105%, when we are starting an intermediate pullback. We didn't even get to 100, and we ended up closing just barely below it. So that's a sign that, again, that maybe we're not really as bearish as we think we are. Like, that's a pretty significant drop in volatility by the end of the day, coming well off of the highs of the day. And you can see on this chart here, the VIX, well above the 200-day moving average. Usually what that means, when you get well above, when you break well above the 200-day moving average like that, you tend to make a run back down to it, or at least down to like the 17 or something here. We're well above all these moving averages. There's a good chance that we're going to come down. Then it's going to be a matter of, do we bounce back off of it after coming down? Do we bounce back off of it, or do we break back down through it? That's the next question, right? So I expect over the course of the rest of this week that we'll fill this in. And as we fill that in, there's a good chance that we fill in this gap right here. We're already up to 435 in the after hours. We're a buck up. Now keep in mind that the futures contract is now kind of taken over, and we're up 0.25%. So there's if we fill in that gap, then the runaway gap is no longer, right? It is a runaway gap. We gapped down, we ran away from the open, but we didn't finish down here. So that finish suggests, obviously when it didn't close at the low, maybe we're not as bearish. There's a lot of bullish volume coming in. If that persists, 435 is only right here, so it's got to do a lot more than just 435. So if that persists up into the 440 area, then again nullifies this bearish breakouts that we're seeing, and then we can get back to the normal patterns. Again, I don't think this is the exhale. I don't think this is the dip. This very well could be the kind of the trap, right? Where it gets a lot of people thinking it was the dip, and now we rally, we grind, and we kind of get going again to get people more complacent than they were over here for when the actual painful dip actually does occur. I don't think this is it. I don't think that we are dropping from. I think there's a very good chance by the end of the week we filled, and if not by tomorrow, we filled in that gap and we get back up towards at least in towards that 8-day moving average, at least up towards this 440 area. And again, any gap fill at all is significant. And again, SPY dropped below the 50-day moving average. IWM dropped below the 200. But see, we dropped below the 200 last expiration cycle, and look at the move we had. I expect something similar. If we don't get something similar like that tomorrow, then then of course we know this 200-day drop is holding. That's a very significant 200-day drop, because look, the 200-day moving average is above its 23% line. So now there's nothing below that 23% line to keep us. See, over there, the 200-day moving average was at the 23% line. So they kind of multiple layers of support bounced off of it. This time, there's nothing. There's no volume. There's no long-term moving average. If we don't, kind of fake out this breakdown, then you can see why, in our class portfolios that we have our hedge on for the IWM, because there's nothing down here that can keep us from getting to at least 200, if not eventually all the way down towards 180. There's just no volume. That's on the 1-year time frame, of course. If you look at the 2-year charts, you include the COVID, all the way down to really the pre-COVID high point is your next layer of any significant support after you break through this 23% line, and then the longer term 23, which lines up with a 38% retracement of this intermediate rally. So just to kind of summarize, obviously we have a lot of breakout signals today to the downside. We've been anticipating a breakdown of some point to exhale, not to fall off a cliff, but just to retrace some of this 100% move, or in this case a 40% move without a 5% drop. We still haven't got the 5% drop on a closing basis. So we just haven't had any kind of breakdown we get will just be another red badge here. And you can see when you get the 5% drops, they're actually good things. They lead to 25% rallies and 10% rallies and 19% rallies and 30 and 19 and 38. So it's not a bad thing to get a red bag here. And you don't get a red badge until you're down at least 5%. And you can, if we get down to this 4,000 area, it's actually going to be closer to 10%, which would be a really good sign, because 10% drops lead to the bigger moves, the bigger green badges. So I don't think that this is the drop though that will lead there. I think first that this is kind of the shot across the bow. I think it's going to be bought up this week. I think it was too extreme, too much volume all in one day, right? We had how much volume here? 166 million. The trading range was 7 points, but keep in mind the gap. So we closed at 441. The high was at 436. So we have a gap here of about 440. Let's see, 441 to 436. So that's about 5 points. So we had about a 12-point range, maybe ish in that range, 12-point range, 166 million shares trading hands. So when you look at it here, 12 points is off the chart. Like the top of the chart is 7, so it's off the chart. 166 million, the top of the chart here is about 110 million. 166 is well off the chart, so that's extreme, right? So too extreme to carry forward. Like again, when I talk about we've pulled forward, that's what I'm talking about. So I think this will be the kind of trap type move where it gets people now thinking we've had our pullback before we actually do have our pullback. So potentially a little bit of strength, filling in the rest of this gap over the course of the week, filling in that gap, maybe hitting some resistance up in this area, and then we get our rollover and our more significant declines coming out of that. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish or a lot more bearish than I am? Share those in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today. You want us to do another video again tomorrow. Quick way to give us feedback if you like our videos. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or charts or comments? What do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, come over here, click on this Market Outlook Live button. This takes you to our Market Outlook Live page on our site where I review all previous Market Outlook trades that we've been doing in these videos, whether we should stay in them, get out of them. We actually got out of one today, so check that out. We also put on today's trade idea already before the market closed, so that's a benefit. This is for our subscribers, for actually all of our subscribers get access to these videos. You can also click on, see down here that you have these other our upcoming classes that we have. If you come up here to our trading rooms tab, you can see all of our upcoming classes that we have coming up this week, including our Q&A sessions that we do for our premium subscribers. So check that out. Come over here underneath, scroll down, click on this heart icon, opens up a new tab. Hit that like button there. Also hit this thumbs up icon on the Facebook image that opens up this tab. Hit that like button. Again, the more you do that, it helps us get our content out to all of our followers. Like, there's a lot more than 64 people that follow that Facebook page, but that's all the people that see it because of how their algorithms work. So that's why we always ask, appreciate those who like those. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at what's driving the price action today. Of course, everybody knows what's driving the price action today is what's coming out of China with the default, potential default of one of their bigger banks over there involved in real estate development. So when you look at that and you think, okay, well, EEMs down here at the bottom already had been weak because a lot of this that's coming out in the news has already been out there. So it's not like today is anything new. It's worsening, but it's not new. It's not unexpected, and that's why you don't see a whole lot of decline, and why you've already seen some decline from an emerging market standpoint. In fact, it's kind of flushing out a lot of the emerging market bearishness to an extreme, right? So it's actually a really good sign for them. If you look at just what happened here today alone, and here we go, we'll just come over here to like just today's move. You can see the biggest movers to the downside were all the biggest equity asset classes, emerging markets, small cap, U.S. small caps, and U.S. large cap tech. They were all down to the downside. Developed markets and the S&P kind of were down to. Neither one of them eclipsed the 2% mark. And the Qs and IWM barely finished below 2%. They actually ended up coming up quite off of about a 3.5% drop at their lows of the day. You can see real estate rally, commodities were down. Not surprising to see bonds rallying, gold rallying, the dollar. Like when you see the dollar and gold moving higher, that's a pretty decent sign. But remember, that's not like the dollar's strength is not new either. That's something we saw and discussed last week. It had dropped back below the moving average and gotten dark pink shading in a red line, and now it's, the intermediate line is actually below. Now it's not very far below the 30-day moving average, so that's why it's not like we're tanking here or dropping hard. And if you take a look at bond prices, they've had a nice good rally. They've already been moving higher, just exactly like we talked about on Friday. But even today's move didn't like break you out to a new trend at all here. And you look at gold prices, and gold prices have been so bearish that it's more of a bounce up off of some really, it's still got a long ways to go just to recover some of that gap that it's had. So this is hardly the safety trade breaking out to new moves, to new trends. It's more of, okay, yeah, there's been some risk aversion out there for some time, and a lot of it's coming to fruition right now. Like it played out today in one big fell swoop, and more than likely it's going to have a hard time maintaining it because of how extreme the moves were today, and then how we didn't finish at the extremes, right? We didn't finish at an extreme enough to say, okay, here we go. We are now moving significantly to the downside. Here's all the major global economies that are out there, and you see, okay, we got China retesting these lows, a little bit of a kind of a triple bottom potential forming here. This time without the cluster. You can see we're not quite below 20 on these lines. You are below 40 on all of them, and we have been below 40 in the near-term line for quite a while. So we'll see if we follow through on this or if we end up triple bottoming at these levels for China. You can see Japan pulling back, India pulling back, but still dark green shading and green line on both of them. You can see these developed markets, like look at Germany dropping sharply to the downside, UK, France, all dark pink shading and red lines all across the board. Italy and Brazil giving you some clusters, but everything just dropping like a rock here. Remember, Korea is a sign of global economic growth expectations, has been a proxy for that in the past. It's been on the bearish trend for a while. This is nothing new to it either. It's already been dark pink shading and a red line for a while here, as well as like Brazil and China and some of these other globals had some bullish runs here, but over the past 3 months, it's really only been Japan here lately, and India for 2/3 of this 3-month cycle, and U.S. for most of the 3-month cycle has been bullish. Everything else has already been in a little bit of a decline. If you take a look at the currencies and how they performed, here's all the major currencies we talked about. The pound, the euro, both falling today against the dollar, the Australian, New Zealand dollar. In fact, if you look at it from this perspective on the comparison, and again, just look at today. So let's come here to September the 20th. And look at today's move. You can see that, it's interesting to see what this is. This is for most of the day. This is coming from Sunday into today for most of today's move. The euro is actually up a little bit against the U.S. dollar, and the Japanese yen was higher against the U.S. dollar, but the Australian dollar was higher than it, and so as well as some of these other. Swiss franc was up. That's considered a safety trade in Europe. So it's hardly this was hardly a risk-off move from a currency standpoint. So again, not as significantly bearish as again, very extreme on the equity side, but not really very extreme across a lot of these other areas. You can see like Crude oil is not breaking down. Commodities or gasoline not breaking down. Natural gas still on that extreme bullish trend, but giving back some of it. Copper is not breaking down. Still, I mean, it fell, but it's still in a range. Silver is giving you a cluster here. So it's, it's not. It doesn't seem like there's the risk off trade. The risk on trade is breaking down through significant support levels. It doesn't seem the safety trade itself is taking off. It just seems like we had a very extreme move in equities, and more than likely will bounce back up and get people thinking that was probably most of the risk aversion out there until we actually do get a breakout in the safety trade. And more of a full-on risk aversion across all these different asset classes. I think that's still coming. I don't think today was the start of that. I think it's gonna make it look like today was all of it, and then as we rally off of it and get more settled down as we head into October, then we'll get more of that weakness. I expect by the time all is said and done. All right, one area of the markets that really struggled today was the financial area. So as we saw with obviously that's where a lot of this is coming from, at least from the Chinese financial sector, but it's bled over into the U.S. as well. And one stock in particular in that area, Morgan Stanley, down 3% today on its own. You can see it had been very strongly bullish, and getting a little bit of a long lower shadow itself. But well below the moving average, down about almost 5% below the moving average, which is a significant pattern for it. Its market sentiment, its intermediate line's down, no longer bullish, and it's got a pretty steep decline. If you take a look at its long-term crossover chart, MS here. You can see it's a pretty significant bearish candle. The Hakken-Yashi's turned down, the red arrow. You've got a gap between the 50 and the 200 that the trade in between. You still have a very high PPO. 15% is a very strong number. Very, very strong number. In fact, when you look at the two-line version of the MACD and stochastics, I mean, we're below the 50-day moving average. That's a pretty wide gap to fill in with not a lot of volume above the value area. The MACD is dropping below zero. It's basically an intermediate pullback we have going on here. We've done this before. We've done this a couple of times. Right there being the last one. The time before that, you kind of flirted with the 50-day moving average and jumped back up above it. If you take a look at the directional movement index, you got a break up above 25. We haven't had that here for a while. What the positive indicator is at its lowest level it's been in a long time, even a little bit lower than what we saw there. If you look at the RSI and the CCI, a little bit off of their lows, but still breaking below 40, breaking below 200. If you look at the Bollinger Bands for it, you can see we broke below the band and the lower Keltner channel as well. When you look at the Keltner channel here, right here. You can see we also broke below the Keltner channel. We got this red momentum bar starting down there at the bottom. If you look at the Ichimoku cloud, we are at the cloud. You can see the red line is broken below price over here. We have the beginnings of a bearish trend. We are below -1. We are above 50. So again, once you kind of keep an eye on that to get below -2 and get above 65. If you take a look, let's see, that was we already looked at the market forecast chart. So when you take a look at its options chain, you say, okay, well, I don't want to be too significantly bearish, but it is relatively bearish to the downside. Looks like I doubled up on the position here during the Market Outlook Live, and I've got an order to close out the other half when I double clicked, I guess. At the price that we got in at, so that's going to be in there until that happens. But if you take a look, if I say, okay, well, I'm not bearish enough to buy a put, but I'm bearish enough for this to stay above or below a certain level. If I sell the 102 and buy the 104 call option, this is what the Analyze tab looks like. We just have to stay down below 102 for us to profit from this between now and October. There is a earnings announcement right before October expiration, so it's something to keep an eye on. But that break-even point, if you notice, essentially the stock has to stay down. Even if it fills in this gap, there's a pretty decent resistance at the midpoint of the 4-week range right there. And that midpoint's going to be there for a while. So, if it stays, in this area and holds that for resistance, there's even a little bit of a pocket of volume right above that that can hold for resistance as well. That blue line is the break even. So it's at a pretty good spot for us to, give it some room to breathe and work with. If you look at the 2-line versions of this chart to see where that 102.60 area is, it is back. It is still below. Let me zoom in on it here. Right there. So there's 102.60. There's that break even. So as long as it stays below the 17-day moving average, which is there now, obviously that's going to be falling through that line. But as long as you stay below the 17-day moving average, we're fine. If we're above it, we don't want to be in a bearish trade anymore anyway. So it's a great place to have that break even in case this does work. And if it keeps going down in the range, if we can get 50% of maximum gain by the end of the week, then we'll close it out and take it and move on to something else for the rest of the October expiration cycle. All right, so that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new threads with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, as well as our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.